Welcome back, my awesome people. I am honored to be here today with Dean Smith. He is the strategic, and you know how we love our strategy, people. He is the strategic of Folio Beyond. We're going to be talking about some really cool ETFs, and not only ETFs, but we're going to look at the market as a whole. Because as you know, right now, things are, we got tariffs, we got wars, we got things going on. So we need to make sure that we understand how to maximize our gains. And we're going to look at some really cool strategies that Dean Smith has not only brought to Folio Beyond, but also managing. And so that way we can get the benefits. Dean, how are you doing today, my friend?
I'm doing great. How you doing?
Doing good. Just waiting for summer to kick in. It's still cold out here in the Great North. So I hope that you are doing nice in South Carolina. So let's get right into it. So Dean, before we dive into the ETFs, what's your story? How did you get into finance? Can you provide an overview of Folio Beyond, its core mission, its history? Can you start us off with that?
Sure. How did I get into finance? Well, that's interesting. When I was a young man, I was actually a musician and just cover bands, touring around, playing and everything. And I moved to California, deciding I was going to become a rock star, and that didn't really work out. So I ended up going back to college, and I got interested in economics and finance, and I turned out to be, pretty good at it. And so I stuck with that. Went to grad school back in New York and studied economics at the PhD level. Started working on Wall Street, and I got interested really early on in what they call now structured products. These are more complicated securities, things like mortgage-backed securities and credit card-backed securities and auto loans, these things that have lots and lots of cash flows and lots of math. And so I was trading that kind of paper for a couple of different Wall Street firms. Eventually set up my own shop called Stonehenge Financial Partners, and we did a lot of really complex bespoke transactions for hedge fund and private equity clients, stuff that they really couldn't buy anywhere else. You had to make it. You couldn't go out into the market and buy it. You had to make this stuff. So I got, a lot of expertise at kind of putting a lot of different pieces together and making the whole worth more than parts. The classic arbitrage that everybody tries to find. Did that for a number of years. Eventually made my way over to a hedge fund called Highland Financial. And there I was the partner in charge of all of the credit strategies. So anything that had any credit risk, I was responsible for. So that was residential mortgage-backed securities, commercial mortgage-backed securities, commercial real estate investments. And then in 2006, having been at this for a while, kind of saw the writing on the wall in terms of the subprime shenanigans. And we launched a fund there that did the Big Short type trade. I'm sure everybody's familiar with the movie The Big Short. Well, that was an actual thing. It's not just a movie. And we did that using a lot of derivatives and things that were very high octane and turned out to perform really, really well when things went badly. And so that was from about 2006 to 2010 or so. And then for the last 7 years, I've been with Folio Beyond. I was one of the co-founders there with a man named Young Lim, who I've known for a very long time. And we were running private accounts, separate money accounts for high net worth individuals and smaller institutions. And we were looking around at the ETF space, and we said, we're at a kind of a turning point here. This would have been about 3.5 years ago. We're at a turning point here, and the era of zero interest rates is going to be coming to an end, and not many people are prepared for it. And so we launched the RISR ETF, and we'll talk some more about that. But basically, this is an exchange-traded fund that goes up in value when interest rates increase. Normally, we've all read that line in the Wall Street Journal, when interest rates increase, the price of your bonds goes down. So bonds and interest rates move in the opposite direction. Well, we have a particular kind of strategy using mortgage-backed securities that go up in value as interest rates increase. And we timed that really well. We launched that, as I say, in 2021, right before the Fed started raising interest rates, and so that fund's done very well. And then earlier this year, we launched another fund, and we could talk some more about the details of that. But so I've been in and around, these kinds of products and trading and managing risk here for pretty much my whole career.
I love how you said that as interest rates go up, bonds go down. And so looking at, for example, with AI everywhere right now, how is that helping the future of not only ETFs but also stocks? Because AI right now, especially with the quantum mechanics, the quantum chips that they have everywhere. I know Google just came out with theirs, Microsoft just came out with theirs, Taiwan Semiconductors just came out with theirs. They're trying to beat the market. Do you think AI is going to play a big role in ETFs and choosing different type of stocks to put in the portfolios?
Well, it already is. I mean, a lot of asset management companies, hedge funds, and ETF managers are using AI, machine learning, right now in their strategies. It's very early days. There are many, many more people looking at it, trying to build the models, trying to figure out exactly what's the best way to use AI and machine learning in the investment process. Um, so there's certainly still plenty of fundamental analysis being done, but more and more that is being taken over by these sophisticated models. And I'll give you an example. We talked about credit a little while ago. Now, typically, the way that credit risk is assessed is that the analyst or the investor gets a bunch of balance sheet, cash flow statements, income statements, and goes through these and maybe builds a spreadsheet model and compares what's happening to the company over time, compares what's happening to the company as compared to its peers, its competitors, and tries to come up with a credit assessment based on this fundamental information of how likely it is for this company to default, to pay its debts on time, how likely it is that the particular debt instrument might be called or extended, all the things that can happen. Well, what's happening now is these tools, these large language models, which are things like ChatGPT and Perplexity and Grok and those kinds of things, are getting really, really good at reading that kind of information, going through balance sheets and financial statements, and they're getting a lot better at it. They're still better with text than they are with numbers for the most part. I mean, there's a famous or infamous joke out there that if you ask if 9.1 is bigger than 9.01, and a lot of times we'll get that wrong because it just doesn't. It's not seeing the numbers as numerical concepts all the time. It's looking at them as English language, but they're getting a whole lot better. And so these models are being put to use in a way that's going to really enhance the ability of analysts to do their job. It's going to replace some, for sure, but it's really going to be much more the case that it is. There's another expression that says AI is not going to replace you. A person using AI is going to replace you, right? So it's the combination of human intelligence and intuition together with these tools that is what's really driving the development of AI and machine learning in these markets. And it's pretty exciting. It really, really is.
It really is exciting. And I love that you said that it's not about AI replacing you, it's about the human behind the AI. And so just to go back to the ETFs at Folio Beyond, so the RISR, the Alternative Income and Interest Rate Hedge ETF, and the FIXP, the Enhanced Fixed Income Premium ETF. Can you tell more about what those ETFs, their holdings, why should investors invest in those ETFs? Because I did look into it and I really love what I'm seeing. They are safe, reliable, but at the same time, high income producing ETFs.
Right.
And also the strategies. You are using, of course, AI, but also using option strategies. Can you tell us more about that?
Yeah, let's take these one at a time. They're very different strategies. They have some similarities in sort of the way we approach investing and risk management, but strategies themselves are quite different. So the RISR, RISR, we launched, as I said, about 3.5 years ago to take advantage of what we saw as a really fundamental change in the marketplace with the end of the zero interest rate legacy and perpetually, we think, maybe not perpetually, but certainly for the long term, higher interest rates than a lot of people are used to. If your memory only goes back 10 years, you really don't remember a bear market in interest rates. If you've been around a little longer, then you know that interest rates can go up, and they can go up quite a lot. And so we launched this strategy as a way to provide investors a tool to manage their interest rate risk. There are a lot of individual investors and institutions that have substantial fixed income holdings, right? So classic 60-40 equity bond portfolio is held in, more or less that form, not exactly 60-40 maybe, but some portion of equities, some portion of bonds or fixed income. And that fixed income piece is supposed to be like the stable piece, right? You buy the equities for the upside, and you buy the bonds for the income and the stability. But in a rising interest rate environment, they're not so stable. They go down in value. So you can, if you look at the price return of the aggregate bond index over the last 3 years, it's been pretty bad. You've lost probably 35-40% of your money. What we do with RISR is we buy a particular type of mortgage-backed security. I don't want to get too technical, but these are securities that are sensitive to prepayments, right? If you have a mortgage and interest rates go down, what do? You pay off that mortgage, you take out a new mortgage to take advantage of the lower rate, right? So if I own that mortgage and you prepay it, my cash flow goes away, right? But if interest rates go up and I own that cash flow from those mortgages, those thousands and thousands and thousands of mortgages, then the people don't prepay their mortgages and I receive that cash flow for longer. That's why the value of my investments in RISR go up when interest rates increase, is because the prepayment rate of these loans slows down.
That is a really good point. I never thought of it that way.
Yeah, so these are very specific kinds of mortgage-backed securities. Retail investors really can't buy them. It's an institutional product. The mortgage-backed securities market is an institutional marketplace, right? So what we're doing with this fund is we're taking an institutional hedge fund style investment strategy, and we're making it available to retail investors through the ETF. Okay, and it's done really well. It's been up since we launched it in October of 2021. It's been up on a compound annual growth rate of just a little under 17.5% per year.
Oh,
So
wow.
about 80% since inception.
That's a good
For a
balance
fixed
between
income
high
fund,
risk and high reward.
that's pretty good performance. It's the number 2 fund out of 254 funds that Morningstar tracks in the alternative fixed income category. And it pays about a 6% dividend.
That is
So
actually really good because I know it's not considered a REIT, is it? It's not a REIT.
no,
It's
it's not a REIT.
okay.
No.
So because I know with REITs, they have, great dividends, they manage consistently. And so this is just another, I guess, way of using real estate, using mortgages to also gain a premium income. And so how do you decide which new products to add and take away? Is it more of as time goes on, you see the market, you see the trends? How does that work?
Yeah. The type of mortgage-backed securities that we buy, they're called interest-only securities. Again, we don't need to get into all of the details of it, but it's a huge market. Okay, it's many, many hundreds of billions of dollars of these securities. So every day I get from all the Wall Street firms, from Goldman Sachs, from Barclays, from JP Morgan, from Citi, everybody, I get all of their offerings, everything that would potentially fit into my fund. Okay. And then what I do is I have a machine learning program that takes all of those securities and it looks at the underlying mortgages. There's a vast amount of data that it crunches through. It gets some of this data from Bloomberg, it gets other data from other data sources and other data vendors, and it crunches through all these things and it tries to figure out for each one of these
This is
securities.
an amazing machine. I wish everybody
Yeah,
had
it's
this.
it's it's pretty it's pretty advanced mathematics. It really is. But what it's doing is it's going through and it's saying how likely are the loans in this pool to prepay based on the current economic environment, based on where the loans are located. Are they based in are they mostly in California, Texas, Florida? Are these investor properties? Are these owner occupied properties? Are they refinance? Are they purchased? So it's looking at a whole bunch of characteristics. The individual investor could never do this on your own, right? It would make your head explode, right? But we have the tools to be able to do this, and I've been doing this kind of analysis for a long time. So I go through those hundreds and hundreds of securities every day, and then my algorithm goes through and it ranks them. And it says, based on the offering price and based on the characteristics of the loans in this pool for this mortgage-backed security, this is the most these are the cheapest bonds, the most that have the best value, and it ranks them from most attractive to least attractive. And then based on how much capital I have to deploy, I will kind of start at the top and work my way down the list. And so this is still, even this is where it gets kind of fun, because even though we have all of this analytics and all of these computer models, when it comes time to actually trade, okay, I'm actually talking to a live human trader on a trading desk at some Wall Street firm. And he says, I'm offering this bond at 7.5. So 7.5 cents of the notional amount of loan principal. And I say, I'm not going to pay 7.5. I'll pay 7.16. And then we haggle and we get it narrowed down. So there's still an element of the trading
Of a
and
human conversation.
the rug bazaar and the human conversation that gets brought into the mix. And so there's a lot of data analytics, a lot of number crunching, a lot of model building that goes into this process. But at the end of the day, I've still got to. It's like buying a used car. I still got to talk to the salesman,
You
and
still gotta
we
check
have
the
to work out a
Carfax.
deal. Yeah, yeah.
And
So
the cool thing is I've interviewed probably, I don't know, at this point over 100 CEOs, and they all have their own AI tool or AI machine. But the way you're putting yours is actually so phenomenal because it literally gives you the blueprint of what to do
yeah.
next. And so, whether you're using the AI or not, maybe your personal thoughts, but where do you think the S&P 500 is going to take us? I know right now I mean, it was just 5,200 maybe 3 months ago, 2 months ago. Now it's over 6,000. Do you think we're going to hit a recession? Some say yes, some say no. Is this good for the market? Is this good for your ETFs? What do you think?
Well, first let me caveat by saying that we're fixed income guys. I'm a fixed income guy. I
Okay.
don't spend an awful lot of time thinking about stock prices. I mean, I care what's happening in the stock market. It's a very important indicator of the health of the economy and the financial markets. But everything that we do is involves fixed income bonds. Having said that, the problem that I have with thinking about the stock market right now is that it's so heavily dominated by a really small handful of companies, right? The
Yeah.
so-called Magnificent Seven are driving everything. And, if, again, we get back to the AI thing, you've got NVIDIA and you've got some of these other companies that are very, very dependent on the AI rollout and AI adoption and all this. And it shows no signs of slowing down. I guess Apple threw a little cold water on things with a paper that they published yesterday, a research paper we can get into if you want to. But the
Oh, yes,
reality is
please.
AI is,
I
yeah,
never, what's going on?
yeah. Well, Apple published a research paper yesterday or in the last several days. Yesterday was Sunday, but over the last several days, where they said these large language models give the appearance of reasoning, of human type reasoning, it's an illusion. It's not. They're not really thinking about things in any way like the way humans think about things. And depending on how you want to read that paper and interpret it, they're kind of saying they might not ever get there. So now there is
They're just
a
making
lot of different.
statements. They're not really making actual, whether it's mental, emotional kind of thinking. It's just
Yeah,
statements that they're putting out that, when looking probability wise, makes sense for that question being asked, I guess. Is that what their paper maybe
yeah,
is
yeah.
trying to
So
say?
so the way that these large language models work, and I apologize if your audience already knows this, but basically the way they work is you have a prompt, you ask it a question or make a statement or ask it to do something. It takes those words and it parses them into what it calls tokens. So it'd be phrases and sentences and words and so forth. And then it says, when have I seen this group of words before? In all the millions and billions of documents that I've read over all after scraping the entire internet, when have I ever seen this group of words, this group of tokens before? And when I did, what was the next word that followed? And that's what they do. And so it makes a prediction about what the next word is. And it says, okay, I guess that word, what's the next word that it's likely to be? And it
So it's pretty
progresses
much
that
just
way
kind
step
of
by
fitting
step.
a puzzle piece. It's
It's,
not
it's
really,
fitting a puzzle
it's
piece,
not
exactly what it's
originality.
doing.
It's just, this fits
Nope.
here, this fits here, this fits here.
When I've seen this group of words before, what's the next word that follows on a probabilistic basis? That's basically how they work. And so again, without getting too deep into the technicalities, Apple, this paper that they published, said, that's not really the way humans think. That's not really what we do when we reason. It's a much more abstract and complex process. And I don't know if these little models are ever going to get there. So, but in any event, we started talking about stock market, and so it's so heavily dependent on what's happening in AI that it's really hard to make a prediction. Sort of 90 days out, 6 months out.
I
I
don't, it
mean,
changes so
it took a
fast.
big dive. It obviously took a big swoon, on the back of the tariffs, and we're going to probably get to that, I assume. But it's recovered almost all of that. Um, so, you know,
No, and
it's really hard to say, but go ahead. Yeah.
no, I totally agree with that, because I know we put tech and AI into this big category of this is the future. I know Nvidia about 6 months ago, they had their presentation where, we're going to not only autonomous cars, but now autonomous assistants and so on. But I think when it comes to AI, it's just like the tech boom, right? Back in 1999, 2000, nobody really knew where the internet was going to go. We just knew that we can answer emails, we can do maybe a video chat, but now the internet is pretty much our lives. I mean, if we can't
Yeah.
access the internet for 2 minutes, many people start freaking out. And so I think that's
Yeah.
what
Yeah.
AI, in my personal opinion, is going to be like. Right now, we're in that .com era where we're learning what it can do, what it can't do, what regulations are going to appear, and so on. And so we are going to talk about tariffs in about a minute, but looking at AI and also cryptocurrency, blockchain, do you think that crypto is going to be something? Some people say no, some people say yes. I have a few dollars in there, not too much, so I'm not like a crypto
Exactly.
fan. But what do you think about cryptocurrency? Do you think maybe you might create a crypto ETF, maybe a spot ETF? What do you think?
Yeah. We certainly wouldn't launch any kind of a crypto or Bitcoin ETF. That's just not really our thing. Um, the main use case for cryptocurrency, unfortunately, seems to be getting hacked. There's been a lot of crypto stolen over the years, and it's not because they can hack the algorithm. It's just because they hack the repositories, and people are careless with passwords and things of that nature. But um, sort of leaving that aside, I think crypto's here to stay. The thing that concerns me about it longer term is something you mentioned at the top of conversation here, which is quantum computing. There was another paper that was published recently that suggested that it won't be too long before quantum algorithms can break the hash that protects and secures cryptocurrencies in like a reasonably finite amount of time, days, weeks, or months, whatever it is. But it's, it was once upon a time people said it would take, a million years or whatever, to crack Bitcoin. And now with quantum computing,
It's
that's not the
happening.
case any longer.
Yeah.
It's yeah. So I don't know where. I'm not smart enough or informed enough about it to know exactly sort of how much of that I'm supposed to care about or we should worry about. But it's definitely a problem on the horizon for crypto.
Definitely. And that's
But
one
yeah,
thing that I'm also scared of too with this quantum knowledge and technology. It can possibly break the blockchain. It can possibly break through the security. It can
right,
possibly, say, you know what, nobody gets Bitcoin anymore. Everyone gets a zero. It's one of those fears. So a lot of my
right,
viewers, they keep saying, crypto is life, crypto all the way. But, with the way technology is, it may not be as safe anymore. As you said, the depositories, it's not really the actual blockchain, but the depositories where they're
right,
held, the hot wallets and so on, like Coinbase, it's always getting hacked,
right.
unfortunately. And
Yeah.
so when we're looking at,
Okay.
any new themes or products that you might be coming out with, are you thinking of anything to come out with in the near future?
Well, we just launched back in, was it now June, January, the end of January, we launched the FIXP, FIXP exchange traded fund. Now, what this fund does, very different from RISR. This fund looks at the entire bond universe. So it looks at short term, medium term, long term treasuries. It looks at municipals. It looks at investment grade. It looks at high yield. It looks at REITs. You mentioned REITs a minute ago. It looks at REITs. It looks at all the different sectors of the fixed income marketplace. Okay. And we go through an analysis that goes to the underlying securities in these things and determines the default probability of those. And so for each of the ETFs, we're able to come up with an actual default probability adjusted yield. Okay. This is very important because the nominal yield of a high yield bond, for example, is almost always going to be higher than for an investment grade bond, right? But there's a higher risk of default. So what you really need to do is you need to put those on an apples to apples basis and say, when is the high yield bond actually cheap on a risk adjusted basis to the investment grade bond? So we do that for the entire fixed income marketplace. It's about 23 different sector ETFs that we look at. And then we have, again, an algorithm that uses machine learning and it computes a whole bunch of indicators for each of these. It looks at the volatility, it looks at the momentum, it looks at relative value across these things, and it allocates to whatever is an optimized portfolio of these ETFs. And so it'll invest somewhere between, 5 to 10 or so out of the 23 that are available to it. Okay, so it's looking at the entire fixed income universe and taking a very, very disciplined approach to allocating the total capital of the fund. So we have now a optimized portfolio somewhere between 5 and 10 ETFs that we think are the best, most attractive right now on a fully risk adjusted basis. Okay. So we have this optimized allocation across fixed income. Then, in order to generate additional income, we write call options against those. Okay. And the idea there is that if we choose things wisely, that most of the time we figure those options are going to finish out of the money and we just collect the option premium. It's not guaranteed, obviously, but that's the basis of the strategy to generate additional income from those. So that fund, as I say, it's only been up for a couple of months. We're kind of excited about it because there's not really anything quite like it out there in the marketplace. Producing a dividend yield of around 6.5%. So again, focus on income and stability for these products. What we're trying to do is we're trying to create uncorrelated returns, right? So in the case of the RISR, the RISR fund, it has negative correlation to the bond market, zero correlation, almost zero correlation to the stock market. The FIXP has very low correlation to other markets because of the way that it's structured, and both of them are generating a north of 6% dividend yield. So stability, current income. We think in the current market environment, which we can get to, I'm sure, in a minute or two, those are the two most important things for investors to have in their fixed income portfolios.
And I think that's the best way to do it, because most of my audience members are dividend investors. We're always looking for a distribution. And I think that in the past few years, we can tell that a lot of distribution type ETFs are the way to go because of the volatility. You don't know what's going up, what's going down. Like I remember a lot of people, they invested heavily into Tesla. However, I'm sure you've known what happened in the past 6 months. He got into the White House. The shares tanked. So I think moving forward, a lot of people need to start realizing that we are going to go through volatile times. And so now, talking about volatility, let's look at the global economics, the macroeconomics.
Sure.
What is going on? Like CEOs, portfolio managers, the average retail investor, we're all just watching the news, whether it's CNN or Fox. That's where we're getting our information from. But someone like you who is on Wall Street, who is in the know-how, what are your thoughts and opinions?
Wow. It's a mess. There's really no other word for it. Let's start with the tariffs. This rollout of these tariffs, what they put Liberation Day on April 2nd, was one of the craziest things I've ever seen in economic policy. The so-called formulas that they were using to set these tariffs for these different countries made absolutely no sense. They were on again, they were off again. They, paused them for 90 days. That 90 days, by the way, is quickly approaching. We're now 60 days into the 90
Yeah.
days. And there hasn't really been much in the way of progress for any of these trade agreements. They sort of announced something for the UK, but the UK is not that big of a trading partner. Our two biggest trading partners, Canada and Mexico, we'll get something worked out with them. But I think it's worth mentioning that the last agreement that we had with them, NAFTA, that took a year to negotiate, and it wasn't implemented in full for 2 additional years. So to think that anything is going to get done in 90 days is fantasy land.
It might
Okay.
even happen
But
after his term.
yeah, yeah. And so you now have
Wow.
China, and the one that nobody's talking about is the EU. China is in some ways easier, in some ways more difficult to work out. It's easier because you basically got one dude, Xi Jinping, right? If he's on board, the deal gets done. If he's not on board, the deal doesn't get done. Having said that, the Chinese are very tough negotiators. They take a very long view of things. They've been preparing for this for a long time. Okay. They've been making, strategic investments in Africa, in rest of Asia, all over the place. They have a strategy, and they are not going to, you know, they don't really care too much about
They're
the
standing
Trump
their ground
administration's timeline.
because,
They really
yeah.
are. They are not going to. Nothing's going to get done in 90 days with the Chinese. I guess they're meeting in London now, but nothing's going to get done in 90 days. Then you've got the EU. Okay. U.S. bilateral trade with China is around 600 billion a year. U.S. EU bilateral trade is almost double that, $1.1 trillion per year. That's gross flows back and forth, right? And the EU isn't a single entity. It's around 20 different countries.
It's
and they
kind of like a
all have
continent.
yeah, it's an entire continent, right? And they've all got very different priorities. France's concerns are not the same as Germany's concerns, which are not the same as Spain's concerns or Italy's concerns. Getting a deal done between the US and the EU is going to be extremely difficult and extremely time consuming. So to think that this trade tariff war is going to get wrapped up anytime soon is just crazy. It's not. It's going to take a long time. And whatever happens with the courts, the Trump administration is not going to give up on this. Okay, this is their core economic policy. This is what they ran on. Trump has been talking about tariffs for 30 years. Okay,
Yeah, I've
they
seen
are
a lot
not
of
going to
video
just
clips where he was talking
yeah,
as a young Trump.
yeah, when he was a real estate guy, which I guess at heart he still is. But so this is not going to just go away, going to get resolved. This reordering of the international trade system is going to be with us for a very long time. So
Do you
that's the
think
tariffs.
do you think it's about time? Do you think these tariffs are long overdue? Meaning maybe America, because as a Canadian, we don't really get the American news. We don't really understand American economics as well as I'm sure Americans do. But do you think this is something that is overdue, long overdue, or is this something shouldn't even be happening?
Well, as I mentioned at the top of the conversation here, my I studied economics, and when I went to school into grad school. So for me, free trade is, almost a religious belief. Okay. The benefits of free bilateral trade are pretty impressive. And that's been sort of known for a long time. Now, that doesn't mean that there aren't costs. And those costs have been underplayed, downplayed, undervalued for a long time. And as a result, you know, we found out during COVID that we don't have the ability to produce a lot of things that we really should be able to produce for ourselves. So something had to be done. There needed to be some sort of reworking of the international trade system. We needed to, do something about rebuilding the hollowing out of some really strategic industries in the United States. This tariff chaos is not the way to do it. This is not going to achieve, excuse me, not going to achieve the administration's goals. It's just going to sow chaos. And so, I wish that there was a more thoughtful process happening here, but
Yeah, because I think,
we've got
as
we've got the president we have. We've got Peter Navarro and Howard Lutnick and the guys that are running this. Scott Bessent is the adult in the room at this point, it seems like, but he's one guy and he's got a day job in addition to trying to work out these tariffs. So that's sort of one mess. And then you've got this big beautiful bill.
yes, please tell us more about that.
Yeah, the big beautiful bill. Whether you agree with the Congressional Budget Office analysis or you don't agree with it in all the particulars, it doesn't really matter. This, if it were passed in its current form today, this will explode the debt, the federal debt. Okay, it is putting us on a path to Japan style debt to GDP ratios, 125, 130, 135% of GDP.
Wow.
That has never been tried before for a country as important and significant as the United States. It is
So that would
also
mean for
caused
every American dollar is $1.30 in debt.
right, yeah, for this compared to the gross domestic product, the total output. Yeah, it's a big problem, and we will very quickly be at the point where interest on the debt is the largest element. It's already larger than the defense budget. And if this bill passes in its current form, interest on the debt would be the number one item. And so this is a problem. This is a big problem.
It is a big
There
problem because
is,
I know the national debt has been spoken about for decades, and they even have a counter, right? The debt
oh
counter.
yeah,
And
that's in
so,
Times Square, right? Yeah.
yeah. So when we're looking at the debt, like of course Canada has its crazy debt as well, but when we're hearing the drama between, Elon and Trump, and he's got the black eye now, maybe there must have been a scuffle in the Oval Office, who knows? But I think the debt should definitely be focused on, because I've also heard that China can at any moment say, hey, we want our debt back, because I believe China is the number one holder of American treasuries and bonds and so on.
Well, they're certainly large holders. I don't know if they're the number one holder or not, but they own a lot of it. And the reason that they own a lot of it is because they sell us more stuff than they buy from us. And that means they're accumulating dollars. And what they do with those dollars is they buy dollar assets, including lots of treasuries.
So what
So
happens,
so
just like worst case scenario, if for some reason the United States does default and this debt does explode, what happens next?
well, what would happen is if the even if the let's stay short of default. Let's suppose that investors around the world become nervous about the value. They think that the US might default, could default. Then what they'll do is they will sell their treasury holdings. When they sell their treasury holdings, the price goes down. Well, what did we talk about at the beginning of the conversation? When the price of the bonds goes down, interest rates go up. Okay. So if you had a
And that
massive,
is where RISR would come in
well,
totally
RISR would be
handy.
be very happy. Yeah, exactly. We would be very happy, but we'd be very unhappy about some other things that are going on. So if the U.S. Treasury is unable to continue to sell debt to these people, or they begin to redeem that debt, interest rates go up. Now, there's only one buyer of the last resort, and that's the Federal Reserve. Well, the Federal Reserve has already doubled its balance sheet of treasuries and mortgage-backed securities, Fannie Mae, Freddie Mac, Ginnie Mae securities since COVID. Okay, it went from around 4 trillion to around 8 trillion. They've been slowly working it down, but even the Federal Reserve only has so much capacity. If the Federal Reserve were to, if international sellers were to come in and say, we don't want to own treasuries anymore, the Federal Reserve would have to buy those. So interest rates would go up. And because the Federal Reserve is buying bonds, they're injecting liquidity into the financial system, you get inflation.
So you get
Okay.
that money printer
So
going again.
you get there. That's the only way. The only way the Federal Reserve can buy treasuries is by printing money, right? They don't have any other source of income. They just create it out of thin air, so to speak. They create deposits at the
And the
bank in the banking
inflation,
system.
we would just definitely go into a hyperinflation at that
You
point.
would go into a much higher rate of inflation than the 3% we're looking at right now. So this is a very dangerous period between trade wars, uncertainty around the U.S. debt and its ability to service that debt. Uh, and, there are lots and lots of other flashpoints around the globe that are making this a very volatile and difficult time to be an investor, which is why, the products that we're offering to investors, and we're looking at other ways to do it as well. It's to reduce the total volatility of your portfolio
And
and
mitigate the
generate current
risks.
income. As long as you have income, you're going to be okay,
And
right?
I agree, because
It's yeah.
as you said, right, like Folio Beyond, they found a problem, they find a solution to that problem. And currently this problem that we're going through is of course high interest, macroeconomic issues that none of us really have control over. And I would say that this is not going to be a short-term little moment. It might take a few years. And during those few years, you have ETFs like RISR to mitigate those risks, especially if you include it in your portfolio. So I definitely agree with that. And so Dean, to stay on that topic, what advice would you give someone that is trying to begin investing or is an amateur investor in this current climate? I know the professionals, the institutions, they have their strategies, but the average investor, how would you, maybe if you gave them some advice, how can they maneuver through this current atmosphere?
Yeah, it's very difficult to give sort of blanket advice because people are in different positions. It's the strategy, the investment advice that you would give somebody who's 60 years old is very different from the advice you would give somebody who's 20 years old. So, long term, 20, 30 years, I think you're supposed to ultimately be bullish on the United States. We're in a difficult patch. We're in for some volatility and some very risky times right now. But you're as a young person, if you're in your 20s, 30s, moving into the prime of your earning, you know, you're supposed to continue to invest. So just invest, diversify broadly. If you have fixed income as part of your strategy, having an allocation to something like RISR, we think makes sense. Again, if you generate income from your investments and you can reinvest that income, that's the most powerful force known to mankind. The power of
The
compounding.
compounding.
And
Yeah,
yeah,
that's
it's extremely
yeah.
powerful. For people who are a little older, um, I think there you need to really think about staying really close to home. Don't there's you see people all the time on the CNBC or Bloomberg or whatever, financial shows, and they're constantly talking about, buying the dip and trying to time the market and things of that nature. Um, that's pretty bad advice for almost any individual investor. You simply can't do it. It's basically impossible for a retail investor, even if you've got a substantial portfolio. It's just not worth it. And then the other
It's
thing
all about
that
the
everybody's
position that
focused.
you're in.
I'm sorry. Go ahead. Yeah,
It's all about the position that you're in, the horizon that you have, and going
absolutely.
from there. Sorry, your third
The
point?
other thing that people keep talking about, and I keep shaking my head, is they keep saying, well, the Federal Reserve just needs to cut rates. The Federal Reserve needs to cut rates. Well, first of all, the Federal Reserve cut rates 100 basis points last year. Okay. And so they've already come down quite a lot. And right now, the last unemployment print was 4.2% last Thursday or Friday, whatever, Friday, I guess. That is not an emergency as far as the Federal Reserve is concerned. Okay. Inflation is still running above the level that they want it to be. Unemployment, 4.2% is full employment in the United States. I don't think the Fed's in any rush to do anything. I think they want to see how this tariff business is going to play out. They want to see how this budget is playing. They're in the same position as you and I. They're watching this and they're saying, you know, pass the popcorn. We don't know
Yeah,
what's
let's
going to
let
happen here.
we have to let it play
But
out.
we're just going to watch for a while. And so, it wasn't that long ago that you had people, talking heads out there saying, oh, the Fed's going to cut 3 times this year. They're going to cut 4 times this year. We just didn't see it. They may not cut it all this year. Okay. If they do,
Yeah, I think last
maybe
year
we'll
they
get,
said they're trying to cut it 5 times in 2025, but that didn't work out.
yeah,
Then they said three,
no,
and then they said
yeah,
two, and then they said one, and now there's really no optimism to be even cutting because of all the things that's already going on.
yeah, yeah. So the Fed's not coming to your rescue in the near term here, barring some, calamity, another financial crisis or something like that. But as long as we just have sort of the level of insanity that we have right now, the Fed's not going to do anything. So it's time to be cautious, generate income wherever you can, and especially for younger folks, let the power of compounding do its thing.
Dean, I 100% agree with you. And that is something that I always say on my channel that, growth stocks, of course, are amazing. But at the same time, there's economic cycles. And right now, we're not in a growth cycle. We're kind of in a who knows what's going to happen tomorrow cycle. And I think when it comes to distributions, dividends, having a steady income coming in, the share price can stay the same. The share price can dip a little, but as long as you're getting consistent income, in my opinion, even with a lot of my viewers, I always tell them, be prepared, be safe, because one day you can have Bitcoin at 120,000 and then the next day could be at 55,000. So growth is great, but also having distribution and dividends is a much safer play. And especially if you have a long horizon, why not take that extra risk? So Dean, you have given us some amazing wisdom. But on this channel, before we wrap it up, I always like to ask my interviewees some really cool questions, just out of the box questions.
Okay.
Are you up for it?
Sure. Let's go.
All right. So if Folio Beyond was a person, what kind of personality would it have?
Oh, it would totally be a nerd. Absolutely, totally be a nerd. Pocket protector, all of it. Yeah, for sure. For
Under the
sure.
radar,
It's
but still
yeah,
making some awesome.
it's we are a quant shop, We I never I don't listen to earnings calls. I don't do any of that stuff. We're totally a quant shop.
Awesome. What was the second question? What was the most maybe random app that you've ever downloaded on your device, or maybe you still currently have? I know some people have like yoga apps, some people have like meditation apps.
Yeah.
What are some random apps that you have?
I do have a couple of meditation apps. I got into meditation about actually during COVID. We were all going a little crazy back then,
Oh yeah, we
and
all
I had
were.
been wanting to try meditation for a long time, and I started doing it. And I don't do it every day. I try to every day, but maybe 5 times a week. So that's good. Um, it's the funniest thing. I've been in Spain for the last 5 or 6 months. I spent a lot of time in Spain,
Nice.
and on long flights sometimes you need just some mindless distraction. So I actually have Candy Crush on my phone.
Hey, I do too. It makes time fly by so
It
fast.
does. Yeah, it does. Yeah.
And then you have
And
to
the
start
sense of
using the other
accomplishment
gummies.
is the sense of accomplishment is just so satisfying. It's great. Yeah.
Oh my gosh, that is so amazing. Okay, so last question. I know you
Sure.
mentioned earlier that you gave up your rock star dreams, but if you were
Right.
not in finance or anything investment related, and not a rock star, but what career choice or path would you have gone down?
Well, I still am very much a music lover, and I had to step aside about a little more than a year ago, but I was on a not-for-profit board here in Charleston, South Carolina, the Charleston Jazz Organization. It's a wonderful non-for-profit. They run a great, amazing jazz orchestra, and they also run a music school for underprivileged kids. We provide them with musical instruments and teach them how to play jazz, and they do concerts and things like that. So anything in and around music, I'm there.
That is amazing. And I'm sure out in South Carolina, they have such a rich musical history. I believe Myrtle Beach is in South Carolina, correct? Or is that
Yeah, Myrtle
north?
Beach is about an hour north of Charleston, right?
Yeah, we always hear about Myrtle Beach and the golfing and the views and the scenic route. So before we end, are there any last mentions? If you want to add anything about your ETFs, my audience will definitely appreciate it.
No, listen, I thank you very much for the time. It's been a really fun conversation. Again, RISR and FIXP both are available, from anywhere. You can buy them through your broker. They trade on the stock exchange. Nothing special about it. It's available to anyone. And, go to our website, FolioBeyond.com. If you've got more detailed questions, you can always get in touch with us. We're always happy to talk with investors.
Perfect. Dean, that was amazing. My viewers, I'm going to have all of Folio Beyond and Dean's information in the description box. So you definitely have to check them out, especially now when things are going crazy. Interest rates are through the roof. People are not able to buy the most simplest things. Last time I heard, eggs were still $7. So check out RISR, check out FIXP, check out Folio Beyond, because right now, as Dean said, we are in dangerous times, not only politically, economically, but hey, this big beautiful bill, who knows what it's going to bring. And my fellow Canadians, we're going through our own mess as well. So just make sure that you're doing your due diligence when it comes to buying ETFs and any type of stocks. Dean, amazing wisdom today. I really, really do appreciate it. I know it's a busy time, so thank you for being here with me today. As I said, all of Dean and Folio Beyond's information will be in the description box. So my viewers, please like and subscribe. And until the next interview, stay ranting.